Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us this afternoon as we take a look at expanded trading opportunities with the CME future options. Now, with us today, I'm very pleased to have Mark Omens with the CME, who's going to open up our event. Now, today's presentation is actually being brought to us due to the efforts of the CME group. It's their dedication to education that has made today's event possible. So I do want to quickly let me put this over. I'm going to pass the ball over to Mark Omens, who will give us a brief introduction about those products and then bring Tim on for today's presentation. So Mark, if you can unmute your phone, let me go ahead and pass you the ball. I've got your slides up, and let's get started here. Thanks, Mark.
Well, thank you, Cynthia. On behalf of CME Group, we are so happy to be here to support Interactive Brokers with our efforts to go out and continue to try to educate traders on the benefits of trading and to different techniques. And I want to thank Tim, before I introduce him, for being here with us on a regular basis to help support our efforts in trying to equip traders with everything that we can and to try to make traders as efficient and profitable as they possibly can be. So I want to thank both Cynthia and Tim for that. Quickly on this slide, just some basic points for those of you that have never traded futures before. Just some basic points are some of the advantages when looking at the futures markets are the capital requirements. There is considerable leverage when using futures. I know this presentation is about options, and we'll get on the next slide to talk a little bit about options. But when it comes to the outright future, since we have this slide up, I just thought that I would mention a couple quick points here. Again, there is an advantage with the capital requirements. That can work for you or against you when you're working with leverage, so please be careful and responsible traders and realize the power that leverage can offer you. If you're mainly a stock trader, this next bullet point talking about the uptick rule and no short selling restrictions, it's a very powerful thing for a lot of equity traders that want to play from the long and short side and be very active in moving around in positions and being able to play the market from different sides. The ability with futures to just as easily buy a futures contract as to sell a contract. Around the clock markets, more and more as you look at earnings announcements and different things that are going on, and as our markets become more and more global and there's more and more activity and movement during European and Asian hours, the benefit of being able to managed risk in the marketplace is becoming more and more relevant, and futures do offer you that around-the-clock market ability to be able to trade virtually 24 hours a day. The last bullet point here, as with any regulated exchange, the financial safeguards are in place with any regulated exchange, which does apply to CME Group. Cynthia, if we could switch to the next slide. Okay. On the following slide here, just a couple points about options for those of you that have never traded options on futures. Basically, from a strategy standpoint, options are options. You want to buy a call, you want to buy a put, you want to do different strategies. They all, purchasing of long options, have limited risk to the cost of the premium and the transaction costs involved in purchasing that option. When you look at the underlying for a contract, obviously, for futures, it's the futures contract. It's not in shares like in individual stocks. One of the things with futures that just forces individuals to do a little bit more education, a little bit more research is the pricing does differ based on the market you're trading, whether you're trading interest rate options or equity options or metals or energies. The pricing does differ by market, and Interactive Brokers has done a fantastic job of making all the product information available to you in a very easy way on their website. Futures options trade both electronically and in open outcry. For most individual self-directed traders, we're seeing more and more rely on the electronic markets. And just to touch a little bit on the two markets that this presentation is going to be focusing on from Tim's perspective is we're looking at stock indexes and interest rates. And the important thing to make you aware of here very quickly is we listen to customers. We listen to what they want and need as traders. And we're happy to say that we currently in the equity space with the E-mini S&P, we have very, very liquid, efficient weekly options, end-of-month options, quarterly, and serial. And just to give you some numbers to get an idea of the average ADV in some of these products, currently today in our E-mini S&P, we're doing about 115,000 is the average ADV for the quarterly and serials, and the weeklies and end of months are both averaging about 21,000 in average ADV. And flipping over to the Treasury side, our weekly Treasury options are growing and growing and growing and are doing hundreds of thousands of contracts a month. And also our regular Treasury options are also very, very liquid. If there are certain types of options that you're looking for, or different time frames, or different structures of options that we don't currently offer, please feel free to share that information with Cynthia and our friends here, and we'll make sure to pass it on to our team. A week or 2 weeks ago, Tom Boggs and Dave Reef from CME Group gave a presentation that is archived on the Interactive Broker site, and it goes into great details about our equity and interest rate options. So please feel free to use that as an educational resource as you continue your studying of the futures and futures options markets. And without further ado, I want to turn it over to Tim Morge, who is a longtime friend of CME Group and CME Group member. He's a licensed CTA, and most of you guys probably already are very comfortable and know him from his market geometry studies. And without further ado, I'm going to turn it over to Tim, and I hope you all enjoy the rest of this presentation. Thank you.
Thank you, Mark, Cynthia. Can you guys both hear me? Everybody hear me?
Loud and clear, we can. Thank you, Tim.
Good. Mark, always good to see you. Cynthia, of course, love working with you. We'll talk about that later. Anyway, just a quickie before we get started. If you came here to listen to someone talk about down and outs and you know, extravagant butterfly strategies and straddles and a bunch of things like that, I would suggest you go back to the beautiful CME presentation from 2 weeks ago. They did a great job, and they go into it in great detail. This particular class is for people that either are just starting to trade options or don't know exactly how options would fit in their strategy, or haven't got their feet wet and we're trying to drag them into the water. The water's fine, come on in. So please do me a favor. Don't type in, you know, I do a butterfly, double backflip, etc. You know, oh, that's fine, but that's not what we're going to talk about today. We're going to talk about, as we always do, looking at market structure, looking at the language of price, watching the flow of the market. When we get to the point where we're going to make a trade, there's going to be two cases here. We're going to look at a bond opportunity and an E-mini S&P opportunity, and we're going to look at short-dated options, weekly options, for a reason. Now, I have lots of options experience. At one point, Chicago Research and Trading was the largest options group in the world, and they actually reported to me when I was the head of trading for a group which is now part of Chase JP Morgan. But I particularly like outrights better than anything. I've done all kinds of option strategies, but the idea here again is find a trade, and there are some times when there are trades and the risk just doesn't fit outright futures or outright cash, and options are the right way to go. So we're going to look at something very simple, and even if you are an options, well, this is not a slur, if you're a geek, if you're an options geek, if you know all the Greeks, you'll know what I mean. That's okay. Watch and see how I use them. I'm sure you may have a better way. That's fine too. But this is a simple way for people to use options in specific situations that will limit their risk and yet let them participate in areas where they probably would not have taken the futures. Instead, they'd probably pass on the trade. So let's go ahead and and get started. So that's the basic idea where we're going. There we go. Again, I own Market Geometry along with my partner Shane Blankenship, and we're not a chat room. We just try and educate people, and we talk about everything from soups to nuts. We trade everything, literally, rough rice to Mexican debt to anything. We'll chart anything. We talk about options. We even mentor people on options. So we do it all. Disclaimers. You always have to give a disclaimer. You always have to tell, I think, just tell the truth before you start any talk about financial situations. And IB is one of the best at disclosing all the risks and helping you decide whether accounts are right for you or whether your account is segregated and things like that. Everything is disclosed. They have a very tight ship. You can read this while I talk, but I'm going to just boil it down to a couple sentences. If you're looking for the Holy Grail, I don't have it. Doesn't exist as far as I'm concerned. The Holy Grail is working hard and learning about the markets, how the markets move, the language of price, how the markets move, what the flow is, what's the context, market structure, and surviving during that learning period. But think of it like going to university. You're not going to learn this in 6 weeks. You're not going to learn this in 2 months. It takes some time. Okay, so the idea basically is we want to put you in situations where you can be successful a certain percentage of the time. You start to look for repeatable patterns, but there's no Holy Grail. Everybody wants a black and white answer, and there just isn't one. Okay, so that's why, for example, today, when we talk about today, this is a situation where you could play it this way, you could play maybe 5 different ways, but this is one way to play it and cut your risk. So the last thing I'd offer here, I need my cursor before Cynthia yells at me. 1 second. There you go, you little rascal. Leverage. Okay, please be responsible. I know, and I'm not talking about IB or anybody in specifics. Brokers will often let you leverage yourself to death and trade 10 to 1 or 20 to 1 or whatever, even worse. But be responsible, especially when you're first learning. How about one contract? We have a saying at Market Geometry, earn size. That means, you don't go out and trade 1 and then trade 50 and then trade 100, because then you'll just blow up. Instead, learn what you're doing. After you're consistently profitable, slowly increase your size, and you'll have a better chance of surviving. But pay attention to leverage. You want to trade under leverage. When I trade, I'm actually trading less than 1 to 1, even for my 4 clients. All right. I want to dedicate this webcast, this entire year, I'm dedicating my webcast to my 2 earliest mentors. Dr. Alan Andrews, he was a physicist. He used the work of Sir Isaac Newton. He developed action, reaction lines, and median lines, which are leading indicators in the mid-1920s. It's almost 100 years ago now. Time flies when you're making money, I guess. And made a ton of money, $455 million for the Kennedy family in the 1929-1930 period during the crash. And of course, Amos Hofstadter, who became one of the 2 partners at Commodities Corporation. And I knew him before he was a partner, and then while he was there early on. And then later on, of course, I went to Commodities Corporation and became a mentor there and ran the Midwest section. But Amos, of course, had passed away in 1978. But those were 4 or 5 of the best years of my life in terms of learning. He was very Socratic, and I think the beginning, he's the man right here, risk reward. And I've studied traders for the past 300 years and more. He's the man that really put this in the spotlight, risk reward, and how important it was. And we now do all kinds of important studies about risk reward. And if you can get this portion right and use money management, you're more than halfway there. So Amos will always be near and dear to me. And sadly, I think I'm the last of his students that's still around that is actively trading and teaching because, again, he passed away in 1978. So I'd like to get more and more of his information out there before it disappears. So today we're going to start out and just use a simple call strategy, and I mean simple, to limit risk in a 30-year U.S. bond future. And you'll see when we get there, and it's going to take a while to get there, Some of you may say, where's the options? Where's the options? Where's the options? Well, generally when you come to one of my events, you'll see how much preparation I do before any trade. And this is probably 90% stalking a trade, understanding the markets, understanding market structure, flow, long before we get to decide, okay, what instrument do we want to use and where do we want to get in and all these other things. Be patient and pay attention to what we're doing, even though it may not, even though maybe you came to see, you know, a condor. Well, just pay attention to what we're doing. It'll help you, even if you're an options geek. It'll help you in the long term. Trust me. Give me that for a few slides, okay? So, I always start each morning with a blank chart, and then I observe each market's behavior bar by bar. I begin to mark out market structure, including swing highs and swing lows, and the patterns that catch my eyes afterwards, and that allows me to begin to understand the phase being range, uptrend, downtrend, and the flow. Is the market actually flowing or is it stalling out? The context, that is, of that market, any particular market. So let's take a look at a bond. This is the bond market, and this wasn't that long ago. And you can see, let's take a look at it. Take a second. There's no lines on it. This is how I start every single morning. Even if I have a chart all marked off, first thing I'll do is hit delete all. Start with except for the bars, start with a dead blank chart. I want a clean chart. I want no opinion. I don't want to get up in the morning and say, you know, hear the news and say, oh, geez, I got to go and do some charting so I can buy me some bonds. That's usually the worst time. Somebody asked the time frame, and generally I'm not going to answer questions. It's not that I'm rude. We'll save them for the end, but because I didn't specify this on the chart, let me answer this. This is a 60-minute bond chart. It all depends on whether I'm day trading. If I'm only going to be trading for 30 minutes or 3 hours, I'm going to use a tick chart, something like 352 ticks maybe, or 1,444. But if I'm going to hold it for 2 or 3 days, you know, I might go to 60s, 240, something like that. This happens to be 60s. So if you take a look at it, you should see some things already. And I'll show you what I do when I first start to mark out a chart. Now, this is what I see as the most important thing. Some of you know I teach 5th graders in accelerated learning across the country. I have about a little over 12,000 students. Actually, they're done. This is the second week now that they've been finished. My star was a young lady. In 4 months of trading, unannualized, she made 34.2%. Unleveraged, unannualized. And there's not a CTA out there that wouldn't like to have made 34%. So I had some very gifted individuals this year. The average was well over 17% for the entire group. So that tells you those are stocks long only. So that tells you even trading, you know, from one side only, unleveraged, you can, if you're patient and do some simple strategies and just relax, you can make good, consistent profits. And this is what I teach them right here. This is called a mountain. Just take a look at it. You can see why it's called a mountain. It's an empty space that's shaped like a mountain. And I had to think of something that I could teach 5th graders. It started out 3 years ago when my son's teacher asked me to give a lecture. And I thought, well, you know, I see these formations, and these should be pretty easy to teach. So here's the baseline. Some of you might just draw a simple trend line. We call it a mountain baseline, nothing special. And they have to have a stop over here, and they have a certain stop that's allowable. But I'm just marking the mountain baseline. I notice mountain formed, mountain came back, the baseline held. That tells me that there are some buyers. We call large buyers whales. In a lot of the markets that I trade, I'm one of the top 3, 4, 5 traders in that market, so I can literally push a market around. I'm a whale, and that's not a negative term. It is what it is. Each market, for example, in cash forex around the world, tends to have about 4 or 5 whales, and we don't tend to eat each other. We tend to look for the smaller guys, the guppy food, the orders that build up. We'll take advantage of that. So here you can see lots of bids down here, lots of buyers. Stopped on a dime. We had this wide range bar drop. If we zoomed in a little bit more, you could see how nicely this dropped. This bar dropped like a stone falling from the sky. Who in their right mind would buy this bar? But look at it. It's right at the mountain base. It closed up here. After the bar closes on a 60-minute, you're thinking, oh boy, I wish I had drawn in that line and bought down there. And look, it never revisits it. So it takes off, and I'm just drawing. We're not trading, we're just thinking here. We call this a valley. Why? Well, just look at it. It's like the Grand Canyon. It's a valley. This is the valley rim line, the top of the valley. Now, the question you have to ask yourself is, which are holding? Is it'll help you with the trend, the baselines or the rim lines, the top? The top gets busted right away. There are no sellers. We slow down in this area because we've expended a lot of energy. We get to this area, we slow down. It's like a car driving up, driving 300 miles. Now it stops at the gas station, fills up its tank, and you want to pay attention when you get these tight coils right here. Take a look and see what you get. Wide range. I'm out of here. Had enough of that. Tells you a lot. Who's in control? Well, at the moment, the buyers are. Price comes down. Okay, it's broken back into what you might consider this formation or this range. But again, what did it do? Found buyers. So the buyers that were down here, if they didn't get enough, after this first test, they've moved up here and they said, okay, I'll buy here. And of course, now they're starting to step in front of each other. And you can see higher highs, higher lows, higher highs, higher lows. What am I going to mark out? I'm going to mark out the next major high. I didn't even get a chance on the mountain baseline. And what do we get? Gets tested a few times, busts through. Everybody's all excited. This is where all the breakout buyers, now they're getting long finally. Oh, I got to get long. This thing's going to go to the moon. And where are we at? We're at 140, just over 142. And look at the volatility increase as we break out. Same here. Look at the volatility increase. These are stop loss buyers and people that are stopping themselves in the new long positions. Well, at some point, we actually run out of buyers. Everybody's long that wants to be long. And price begins to dribble back down. I have nothing to draw. There's nothing other than price moving back down. So let's see where we can go from here. I'm starting to see some things. Take a look. One last chance before I move the slide and see if you see anything interesting. I'm going to tell you in advance, this first portion has some of the most beautiful market geometry or symmetry that I've seen in a long time. A very, very long time. So think big chunky ideas. Ready? Let's take a look. So as I mark out the simple swing highs and swing lows, and the reason why I put the verbiage up here is because when you get the copy of the slides, you're not going to be able to hear my voice unless you're doing the playback at the same time. And Cynthia and I talked, as long as it's okay with compliance and I don't say the wrong thing, you have my notes right in front of you, which is a good thing because then when you review it, you get to think you get to know exactly what I was thinking. Doesn't mean you have to agree with me, but you have a pretty good idea what I was talking about. So as I mark out the simple swing highs and lows on this bond futures chart, I begin to see order literally between the bars. I'm seeing something. It's popping out at me. It's easier for me to show you this than simply just talk about it, okay? And I'm not talking about little bitty things, and there's nothing wrong with this, like wide range bars or lower highs or anything like that. I'm talking about big, chunky, blocky pieces of structure. But in this case, they're going to be gorgeous. This is going to be cathedral-like. Watch this. Did you see this? Beautiful bookend structures. Does this structure look like this structure? And then we've got a coil in between. Nice big fat coil in between. And they're connected with what? Nice vertical movement. Now, if that's not pretty enough, can you all see that? Let me go back one. Did you see that when I was showing you this slide? Maybe not. But if you draw a little bit more, the more you practice, pretty soon you'll start to see it. You go, I think I see something. Then you can start to draw these or just see them in your head. It doesn't matter if you can see them or not. But you can draw them. They're pretty easy to draw. They're just simple boxes. How about this? Now you might say, what's the big deal? Well, I've got this beautiful piece of structure, and before we can bust out, what happens? A very nice, tight range, very tight coil here. Then I start to do my work and move out. So I'm paying attention to big, fat pieces of chunky structure. If you take a look, unfortunately, you'll have to, when you get the slides, you can blow them up yourself. You can increase them. But if you take a look here, what we've got is, my partner Shane calls these bookends. You can see there's actually a big, beautiful wide range bar here, and a big, beautiful wide range bar here, followed by this minute coil where price is just being compressed like carbon into a diamond. And then it blows out into the wide range bar, never retests these lows, and heads higher. When you see this, it's a marker. It tells you, hey, pay attention, something is about to happen. It doesn't. Somebody asked if we entered on a certain side, does it tell us no, it doesn't do that. It's not directional. It tells you pay attention. It's full of energy now. It's compressed. Now it's ready to go. You'll have to wait for it to break out before you know where it's going. But you know that it's full of gas. Something's going to happen. Now that I've drawn this symmetry, I see even more between the bars. Let me take this chart apart, roll it back, and show you what I see hiding there. Let me show you one more time. So there you go. There's a lot more in here, and it's repeatable, it's tradable, and it's stupendously beautiful. One of these slides you're going to actually want to print out because it'll probably be 5 or 10 years before you see another one just like it. It's that gorgeous and tradable. So here we are. Let's just take a portion of this. Let's just take the first, I don't know, it looks like about 40%. Let's see what we can make out of it. Take a look at the naked bars. And again, we're talking about big chunky structure. What do you see going on here? Just think in your mind. You don't have to type. Just relax. Let it flow right over your head. Okay, let's see what I mark out. I'm taking a look. I've got this beautiful mountain baseline. Okay, it's also called a multi-pivot line, which is how Dr. Andrews labeled these, which means it touches a high over here, touches some, numerous lows over here. Some people could draw this and do draw this, and I don't mean this in a bad way, it's just the term we use, simple Dumbo line, which means lots of people in the market may have this line, which is why there may be support there, although if it gets busted, there'll be a lot of stop orders, so you have to be aware of that. If it's a simple horizontal line, a lot of people may be using it. But in this case, it's this mountain getting filled, set up the entire line. And this one didn't even get the chance to test down here, which is a sign of strength, okay? We come up to the valley rim. The question is, you can see people tried to sell it here. We came back down to the mountain baseline. It held. We restored all our energy in this nice, tight coil. Headed higher, couldn't make it down. Look at the volatility pickup. And where do we go? Right to the valley rim. Let's see what happens. Here's the beginnings of what I see. I know a lot of people are looking at their RSI or their MACD or their volume studies or market profile or whatever. I'm fine with that. It's fine if it works for you. That's fine. What am I looking at? I'm looking at the blank space here. It's clean air. No, I don't live in California and wear cutoffs or anything. I'm in the mountains in Arizona. And before that, I was in Chicago for 53 years. I'm wearing my CME jacket today because actually this week is my anniversary of having a seat since 1980. So my wife said to me, hey, she threw me my coat. Wear your coat. So I've got my Blackthorn coat on. And that's when they were IMM seats, which means you could trade everything. And so here you can see the tight coil that I marked out, and here you can see even better the wide range bars on both sides. And here's the this is a very, very tight coil in here. So I see this clean space, I see the tight coil, I can see price come down and try and make it, can't even make it to the multi-pivot line, then look at the volatility pick up as the buyers step into the market. Okay, let's look at a little more data. Now take a look at this chart before I do anything. You see here I've marked out clean space, the tight coil. Take a look at it. Take a look at this section now before I do anything. I want to know what you see. You don't have to write it. You can just send it to me mentally. I send and receive, don't worry. Just take a look for a second here. This is called participation. If I can get you to participate and think, this will be a much better session for all of you. The guys that are answering instead of thinking to me, and the girl actually, and the girls as well, have it exactly right. So let's for those of you that haven't, here we go. Ready? How about this? My gosh, nice tight clean space below. Nice tight coil up above. Clean space below the coil. Does this mean anything to any of you? It's a word for this. And believe me, you very seldom see it that pretty. Inverse works for me. Range shift, that kind of works for me. Pattern repetition, sure. There's a symmetry. There you go, Stevie. That's exactly what I was looking for. Let's take a look. Not everybody sees that. And again, if we hadn't drawn anything, I don't know how many of you would have picked it up, but start to look for these big chunky. When you're just doing your first analysis, these big chunky pieces, they'll really help you pick out where the market's in trouble, where the market's likely to go, where it's likely to find support, instead of indicators and all these other things. Okay, Legos, I like that one. Fractals, sure. Okay, so let's see. Maybe you can't see it, but of course there were some great suggestions. And by the way, you don't have to talk privately. You're better off if you chat to everybody, because then when we go to answer questions, if you do it privately, it won't show up. So you're better off just saying to all, unless it's a private message, to all participants. So maybe you can't see it. Let me take off the price bars. And if your charting package allows you to take price bars off and leave what you've drawn on, this is a very powerful tool, because there was a really wonderful movie called Searching for Bobby Fischer, in which he's trying to teach a 7-year-old how to play chess, this chess master. And he says to him, I want you to think 8 moves in advance. When you know the moves, tell me. When you know the moves, tell me. Just look at the board. And he waits, and he waits. And then he takes his arm and he sweeps all of the pieces right off the table. And you can hear them all hit the floor, and then there's dead silence. And he says, think of the moves. Don't tell me until you know the move. Same thing here. We're going to take the bars off. Ready? See if you can see it now. How about that for symmetry? Take a look at it. Think about it. This is your market map for the moment. It's going to change as time or price moves to the right. But for the moment, this is your market map. And they don't get any prettier than this. Absolutely symmetrical, almost to the tick. And it marks out exactly where the support is and where the resistance is. And when you come to play, that's what you're going to want to know. And you can do it without bars. Then when you put the bars back on, can you see the beauty hidden within the price bars now? What does it have to do with trading this contract? So let me show you how it frames and sets up a trade. See, I'm lucky. A lot of people have to present one right after the other. Cynthia's nice enough let me come every month on a Thursday, and the presentation goes where it goes. So I don't have to worry about being in 45 minutes or anything like that. Generally, we can just talk about the markets, bunch of friends talking about the markets. So here it is now with the bars back on. And you can see the mountain baseline is in control. What does that tell you? Even here, we tried to break back in the clean space down here. Even here, we're in control. What's in control? Are the buyers in control or sellers in control in this market? Think about it. This is the symmetry. This is the market map. And when we break out one side or the other, and when we see how price plays against the symmetry, that'll tell us who's in control. Yeah, the buyers are in control, absolutely. Any way you cut it, the buyers are in control. You can see them here. Well, you can certainly see them down here. You can see them here now, that we have marked out clean space. You can see them here. And this is how the fifth graders trade. And they're doing pretty darn good, so don't shrug it off. And Mark, I don't know if you have children. Again, Mark's gone, so I'll have Cynthia tell him. Barbara, I'm bringing out a book. It's all for charity called Crayon Traders, and Barbara's going to finance part of it because she wants her kids to know what she does. Barbara Schmidt-Bailey, who has been so wonderful in setting all of these up, and was my introduction actually to Cynthia so many years ago. She's actually participating in it, and the reason why she wants her kids to know what she does, what futures are, what trading is, and this is one easy way that, younger adults, let's call them that, because they're pretty darn smart, can learn and be ready, even if it's just to invest their money when they start to make money right out of college, or maybe even high school. So here we are, we breaking out to the upside. You're right, exactly right. The buyers are in control of this market. We've broken out, and then we made another higher high, which is, for me, it's important. This bar is nice, but it's important that we then get a runaway bar afterwards to show that there are fresh buyers, not just stops, fresh buyers. Fresh blood, if you will. New blood. And even again, let's look. So what did price do? Every time price comes down, what do we run into? Buyers. Just bang it. Buyers. And every time it's down here, we like to think about what each swing, what its purpose is. And when a swing unfolds like this, the purpose of this swing is to take out this low. And you can see it fails. It doesn't make it. The purpose of this swing is to take out this low. It fails. It doesn't do it. So we've got higher lows all the way up. We've got the higher highs. And finally, we break out, and we continue to stair-step higher. Okay? There's buyers in the market. Buyers, buyers, buyers. Now, nothing lasts forever. Always remember that. I have been lucky to be part of cornering 4 markets. I'm not going to answer questions about which markets they were and what years, because other people were part of the group or agency that cornered the markets. But I will tell you one thing. Anytime you trade, and especially anytime you have large positions relative to the market, you better plan in advance a way out, because trees don't grow to the sky. And price doesn't go to zero unless, there's bankruptcy. But, in futures, price, it just doesn't go to zero. So you need to have an exit strategy that makes sense, and you need to walk away, because you don't want to walk away when it's moving against you. You want to walk away while everybody else is finally understanding what you understood all along. Take the money and run. So let's take a look and see what happens here. Well, I'd say the tone of this market has shifted. Anybody disagree? I don't think I'm going to get any arguments here. It's a pullback. The question is, are we in a new phase, meaning range, uptrend, downtrend? We were in a kind of a blocky uptrend. It was still an uptrend, though. And we broke out to the upside, and it went vertical. But now we're making lower highs and lower lows. Are we in a downtrend? Are we in an intermediate pullback or intermediate downtrend that's going to slow down? we'll have to see what price does. Are we just in a range? Now that I've found the buyers and the sellers, you know, I'm supposed to be the median line guru, or pitchforks, median lines. We might as well draw some lines, see what that gets us. So let's take a look. Again, beautiful symmetry here. And I'm using the prior symmetry that I marked out before to draw these lines. It's very, very simple stuff. This is something that I invented a long time ago, but I've been showing recently. I call this maximum excursion. I don't know where price is going over here, but what I do is I connect the first run up. This is our point of ignition, if you will. Look at price go vertical. One thing we notice is when at market geometry, when price goes vertical, literally vertical, you can see it's literally vertical. There's no pause at all here. When it goes vertical like this, it tends to fall and fall hard. And what did it do? It retraced the entire move up before it paused. That doesn't mean the uptrend's over. It just means it now has to eat up time or space, depending on which you like to use, before price can go on and do its next leg. It burned up a lot of energy. And remember, energy can't be created or destroyed. So if it expended it here, it has to recapture it. And that's what's going on here. We call this a pendulum pullback. If it violates this area, we'd have a whole different situation. But it didn't. So when it doesn't violate this area and it takes out this prior swing high, I can keep my eyes open and say, you know, I think probably we're in an uptrend. Now we pull back down, and what do? We find buyers down here and head back up. And you can see us retracing a little bit. We went vertical. Now we're retracing a little bit. Now we ignite again. We zoom. And when we get this zoom movement of this prior high, and then come back and lazily come down, but don't make new lows, I can draw in a simple trend line that people, I guarantee you, people are just not drawing. But you can, because now you've seen somebody draw it. I call this a trend barrier. If this gets busted, it's a change in behavior. But at the moment, this line right here is, if you tilt your head to the left, everybody do this for me. Just, I know you'll feel silly, but that's okay, nobody can see you. Just tilt your head about 30 degrees to the left, and it'll be a horizontal line. And you'll be looking at a simple trend line, and then you'll say, oh yeah, I would, you know what, if it was horizontal, I would have drawn that. Well, lines don't have to be horizontal, they can have slopes. So we draw on a simple trend line, and you can see this is a multi-pivot line according to Dr. Andrews. Look at the touches. Second touch is right here. Touch, touch, touch. Now we zoom through it. We come back down it, test it, test it, test it. It's held. So this is a piece of information. Don't have any use for it yet. We'll file it away. Leave it on the chart. It's interesting though. New swing high. This is where we draw our line of maximum excursion. The moment I can draw my line of maximum excursion, I can flip it over. This swing, which was the beginning of that line, gave us this low, which is also at the mountain baseline. I can copy this line with the same slope, put it down here, and in essence I have a center line and an action line, but it doesn't matter. It carries the same frequency as this line. We're just extending it down here, and it's another piece of information. This tells me just about where price should run out of downside energy, much like a median line lower parallel does. Now, what do I think about this market? It's right in front of you. Some of you may disagree. I know some of you said, was it a downtrend? That's fine. I think the market's in a pullback phase. It's a sloppy market. Remember, we're looking at 60-minute bars. So, you know, these are days. So in that case, it's fluctuating, but it's fluctuating to the upside. This is a potential entry area for me. Price will become volatile during and after. Oh, I forgot the one. Here's our important. It's on the next chart, but here's our important piece of information. Somewhere in here is the Fed announcement, okay, on a Tuesday. And a lot of people are watching this Fed announcement. And we all know, especially with treasuries, what happens right at, maybe right before, if the bond traders are frisky, the big boys, and certainly right afterwards, as everybody tries to read the detail. You'll see them in waves. They'll read the first paragraph and they'll take positions. Then they'll read the second paragraph and they go, "Oh, darn it, I got it wrong." And then everything will change. Then they'll read the third paragraph and they'll go, "Wait, no, I had it right the first time." It's very, very volatile for a good hour and a half or so. So volatile that a lot of times you don't really want to take a position because you don't have the opportunity to take a position that's not going to just wipe you out in the volatility. You can be wrong, you can be right, doesn't matter, you're still going to get stopped out. So that's where options can play a role for you, because options have what? Defined risk. If you pay your premium, if you do a simple options strategy, you pay your premium, you're right or wrong. It's most you can lose. If you have a futures position on, you might get bad fills. No offense to the CME. I mean, it just happens. If things go into a fast market, you get filled where you get filled. So you might decide that you don't want to play futures. Well, if you don't want to play futures, you may not trade. Well, what about a simple? If you believe like I believe that this is a pendulum pullback, what about a simple call strategy? And I know people are going to say, well, I have a better idea. I do this or that. No, let's just keep it simple. What about a simple call strategy? I put some money on the table. If it gets down here, right at 141, I buy an at the money call. Nothing special here at all. Now, I wouldn't do this in most markets. I wouldn't do this 5 times a day. There are better option strategies if you're an options trader. There are better strategies, if you're a futures trader. I like outright risk myself, but right before the Fed announcement, I like this pretty darn good. So let's see what I'm willing to do here. Can I enter the market with a defined risk if price comes back to fill the mountain? Here's the mountain right here. This is where we found the last set of buyers. And my question is, will they be there? And if they are, I want to participate, because look at the last leg. I mean, we went from literally 140 all the way up to 140, almost 143. Okay, now we're pulling back. I expect the same kind of action. But I don't want to risk. I don't want unlimited risk, not with the Fed talking. Let's see what I can come up with. So here's the Fed announcement going on right now. You can see, look at the wide range of this bar. And I'm willing to get long here. And this is all I'm willing to risk. Not much. Now you might ask me, if I'm going to buy a call, am I going to do something like buy a put below it or something? I'm not even going to make it that exotic. It's too exotic. It's too much work for me. It's too much thinking. I just want to buy the call to limit my risk. And I'm going to watch it. If price breaks below here, I'm just going to go to the market and recover whatever premium is left in my call option. I'm going to exit my calls and take whatever's left. Okay? And that's if I'm lucky enough to get filled. But remember, as calls move up to the upside, their value approximates closer and closer to actual futures. So at some point up in here, it'll be like holding a future instead of holding a call. So early on, you won't participate in quite as much of the profits, but as it gets up into this area, all of a sudden it's like holding a future. And then you can take care of yourself at that point. So let's see if we can do. Next bar. Let's go back and just look at this for a second. You can see everybody read it. They read the first paragraph. Oh my God, this thing is going to go to the moon, and they all get long. Then they read the second paragraph and they go, oh, wait, he said this about long-term whatever, and then it does this, which is why a lot of people don't like to trade right at the Fed announcement. Then they read the third paragraph. What do they get? Oh, my God, now it's going to go to zero. So they sell everything. Now, if you just draw simple lines in here and you didn't have the work that I've done, you see it falling like a knife and you might think, I don't want to get long down here. This thing looks terrible. Looks like it's going to go to zero. I'm just buying at-the-money calls. Simple at-the-money calls. And they're short. I'm using the 1 week variety, okay? Because I want as little decay as possible. I just want them to just hang in there for a couple days. Again, this is 60 minutes, so it's not going to be a 1 hour trade. Well, it could be a 1 hour trade, but if it would have to go, to 143 for me in 1 hour. That'd be a beautiful thing. You can buy in the monies, cost more. I'm just buying at the money. And this strategy, somebody that I mentored that was the head, I'm not going to name the name of the stock brokerage house, but one of the largest stock brokerage houses in the United States. They're not international, but they're very, very, very large. And he runs all the traders. He's really the president of the company. And he came to see me because he got it right a lot. And when he added up 22 years of his own personal trading account, it netted to just about zero. So you guys are starting to talk Greek on me. See, the thing about it is, a lot of people here, they don't know what delta means. The geek heads do, Daniel, but most people don't. So that's why I'm not even going to bother to talk about it. We're going to make this real simple. We want people to stick their feet in the water and then they'll start to learn about the Greeks. But not even going to bother to go there. So what I taught him was, wait until you're sure you know where the market's going. Then use your market strategy at that point. Don't try and put on 4 different legs and try and strangle the market 15 ways. Slow down. Wait till you see the whites of their eyes, as they used to say. And when you know where the market's going, do something that's a lot more simple. If you're wrong, you're wrong. That's what stop losses are for. Breaks this level, I'll just pitch out what's left and recapture the premium. Generally, it's about half the premium you paid. Okay, so you can see in the first hour, and again, the Fed announcement's at a quarter after, so this is the first 45 minutes. Everybody bought it, then everybody decided, oh my God, when they read the second paragraph. This is the second hour. What'd they do? They came and puked and made a new low. They came right down to the bottom of the mountain. I've got an order just sitting there. Let me buy it here, darling. I get filled in my calls, no fuss, no muss, and look at the close. It's all the way back up here. So that tells me the buyers that were here are still here. But I didn't want to take the risk in futures or cash bonds, because if it continues to be this volatile, look at the size of these bars. I don't want to try and pitch it out in this size of the bars. It's out of control. Again, most of these questions I'm going to answer afterwards. So, I'm long calls, 141, at the money. It's as simple as it gets. Price closes in the upper third of the bar. That tells me there's buyers down here. It's also a nice show of strength for me. I like this position. It feels good. It's acting the way it should. This is what Shane would call the killing zone. This is the area where I want to get in, I want to buy, and you can see the prior higher highs and higher lows. All we've done is what we would call a pendulum pullback. We've gone, it's exactly the same move as this move at the beginning of this entire, turn your head again 30 degrees to the left. And now you can see that this is a trading range that just has a slope to it. So we've retraced, here it is. This set up the slope, the entire trading range, unsloped. If you turn your head now, turn your head 30 degrees, come on. I know you feel funny, but it's okay, no one can see you. And now look all the way over here. It's the exact same move. Okay? And I like even better in case anybody was drawing these, but I doubt anybody was, that it actually penetrated a little bit because it flushed out any stops that there were. Let's see what we get out of it. There's the Fed announcement. Here's me getting long the second bar. Next bar never retraces at all. If you didn't have an order down here, you're not going to get long, period. Not going to happen. Price comes up. You can see the close right here. There's a little bitty gap right there. That's the close of the day. Then it reopens. Price has a small little range. One very small sell-off. Then right back to taking out prior highs. Took out the Fed announcement high. That makes this a swing low. Once it has to take out a high to become a confirmed low. We're working our way higher. And at this point, this is our important high. But we may not be done yet. Now, where are we at? As you analyze your trade, let's forget about whether it's options, futures, whatever. As you analyze your trade, where's your first problem area? Well, the first was, of course, the high of the Fed. But there was still a little volume there. That's not going to stop a move generally. But these two highs are going to be your first problems. If you can get past there, you might find open space. But you might not get past there. And you've already got, remember this, you got in at 141. We're now all the way up at 142.29 at this point. We're selling off a little bit, but let's take a look and see if we can zone in a little bit closer. How about this? You remember when I drew in this change in behavior line? Talk about symmetry. This high, you can see all the tests. Now it breaks through, comes back and retests it from the downside. Andrews would call this a multi-pivot line. Well, I'm going to use it as a center line. So I measure the distance right here, or you can even just do it here, it doesn't matter. The distance from this center line to the very first major low, which was down at this mountain baseline, right? And this is our action line. And this is also an action line. Here's our center line. Here's our action line. Now we're going to measure this distance and just flip it over the top. And this tells us where price should run out of upside directional energy. So here's our Fed announcement. Here's our first area of major resistance. Here's our second area. Well, what are we paying attention to? We know that price had the ability here to pull back. That lets us project it forward the same amount. And you've seen, if you didn't believe this before, you saw how beautiful the symmetry has been working in this market. This is nothing but symmetry. As above, so below, which Sir Isaac Newton, that comes from the Emerald Tablet. Sir Isaac Newton has done the best translation of that. That's from, people argue, anywhere from 1500 BC back to 10,000 BC. Pick your poison, doesn't matter, but it's a wonderful manuscript. You don't have to go read it, don't go look at it if you're not interested in esoteric things, but Isaac Newton actually used it to form his three basic laws of physics. And his most famous one, of course, is this: for every action, there's an equal and opposite reaction. That comes from the Emerald Tablet quotation of as above, so below, equal. So we've got equal movement here, equal movement here. At this area, I go to the market, take my money, thank you, I'm done. And again, let's take a look. It's already Friday. At some point on the Friday, everybody that was short finally got it, okay? And that's this spurt up here. So the people that had to get out, got out. That drives it right into my price zone where I want to take my profit. It's time to take the profits. It's Friday. I want to call it a week. Thank you. Let me out. I appreciate it. The key to this simple strategy, no matter whether you're trading futures, or in this case, I would do options because it's Fed day. You need to buy when everyone is selling, when it looks the worst. But you have to have a reason. Don't just buy because it looks ugly. And you saw how many different layers we had down here that pointed to this area. Buy when everyone else is selling, and then sell when everyone else finally gets it and is buying. And why are we selling up here? Simple symmetry. It worked down below here, it worked here, and it's working beautifully up here. By trading at the edges, your options are going to act much more like futures. And, by the way, by trading at the edges, if you can define the edges as we did in this market map, you'll find that your trading is much better. Let's see what we got. Okay, so I don't use options every day. I use them if they fit the market conditions at the times when I need to limit my risk. I have very, very large positions, so there are times when I have to be careful about liquidity. But there are other times, if I'm just trading my own account, where, I just want to limit my risk. I'm willing to trade it, but I don't want to have open risk. So by using simple option strategies at the right time, I can take and hold positions before economic reports, for example, or before the Fed announcement. Or we'll see another example, which I won't even name right now. You think about what's another time when I would use options. We're going to look at the E-mini S&Ps now. Let me get a good drink of tea, thank you. All right, so let's look at another trade. I can use a simple option strategy to allow me to take a position in the E-mini futures right near the market close. Yeah, Matt got it before I could even, good job, Matt. Right near the market close, right before significant earning reports are due. Because if you're trading futures, there's a 15-minute period where the market's closed in the E-minis and earnings come out. Now, if you had an open position, either a cash position, which most of you won't have, but a futures position, for example, you're vulnerable for that 15 minutes. You got to wait, and sometimes those gaps are hellish. There's no better word than that. So this is one area where, if the market's about to close, and I know, for example, it's not my nemesis anymore because it's not the market leader anymore. But for a long time, I was over. I can't tell you how many on Dell, to the point where I started to mark my calendar. And Michael Dell is a good friend of mine, and from school days. And I used to mark on my calendar Dell earnings out, and I would just not trade anything to do with the E-minis after the second half of the day because for some reason it just seemed I was always out of step on that day. I don't know what it was. So this would give you the opportunity, though, and this is what I use it for. Market's about to close, earnings about to come out, and this was a big earnings day. This was an important earnings day. And I'm going to mention a term that we talked about. Watch the last session, and as Cynthia will tell you afterwards, all of these sessions are recorded. They're all available. You can go back and watch, and I think now this is the 10th in a row or something. And they're also, the links to them are also on Market Geometry under free resources if you can't find them on either the CME page or on Cynthia's page, but she'll show you the link. Go back and look at the last one. We talked about making the moves from the minor trend into major, minor into major, and that's what we're going to do here. So here's our blank chart. Start of the day, blank chart. And this happens to be, ready? 7-minute E-mini S&Ps, 7. Okay? 24-hour. A lot of times, and the reason I say that is if you follow me, a lot of times I trade day only, so I'll leave the gaps in there. But for this particular example, it's 24 hours, so we're showing all the overnight, 7-minute. Let's take a look. Here's one of the closes, and you can see what the whales do. They look at the orders, and they open it lower. Then they let the market do the work. Struggle to get it higher, struggle to get it higher. Gets right into the point where it's about to fill the gap, and where they're right there again. Go ahead. And all these people that are buying into filling because they're so excited about these statistics they've read that are actually not true. The whales are right there. You're guppy food. They're just slurping you up. Price comes back down, makes a small penetration. Then now look at how tight the energy coil is. This is price just storing up more and more and more and more energy. Here's your first indication. We pop down again. And look what happens when we finally break this low. We've got lower mini highs, lower mini lows. When we break this low right here, the spike low, look at it. Look at the volatility pickup. Everybody gets it now. The whales sold here and were certainly on the offer here and probably pushed it off the cliff here, but they're not going to be selling here. Why pollute? You know, if you're like me, why pollute? If you're short up here, why pollute your average? Let the market do its work. Just be passive. Too many people attack instead of just letting the market come to them. It's a very difficult lesson to learn, but it's very important. Don't try and attack. Just find your strategy. Let the market come to you. So they're sitting on the sidelines now. They're letting you guys do the work. Everybody's pushing. They got to get out, or they're selling breakouts, or now they were buying up here. Now they're hitting their stop losses, and the market is just rolling on its own. Finally, runs out of sellers. Everybody that had to sell or wanted to sell has done their thing. Now the market's in a very tight coil again, and you'll see this over and over and over. Price breaks out to the downside. It's restored its energy. People have their opinions. Excuse me. People have their opinions. People have taken a breath now, and it's been, I don't know how much, in 7 minutes how long that is, but it's a chunk of time. Maybe you've gotten a snack, restored their energy. The market's restored its energy, breaks out to the downside. Look at the volatility pick back up again. No one wants, who in their right mind wants to be long, right? So when price breaks out of a tight coil, and again, I left my notes on here for a reason, so that you could all, so this just wasn't a one-off session and you go, okay, that was interesting. You can go back and study this. You can see exactly what I was thinking. And this comes from real trades, okay? So this is me marking up. I'm taking these right out. I've got my trade sheets right in front of me, and that's how you can hear, listen. That's how I do the slides for these sessions. When price breaks out of a tight coil, it's full of energy. The move that comes out of the tight coil should be significant. If it isn't, that would be a swing failure. And we've talked about those earlier. Some of the largest moves in any market begin with failures because most retail and mid-sized traders are leaning in that one direction, okay? And if they're leaning and everybody has the same position and it doesn't take off, of course, they have to liquidate. And that's sometimes what makes for some tremendous moves and some tremendous trading. So what do we see? I want to highlight something extremely important here. I'm not going to draw, but I'll just point it out. Here we go. The retail and mid-sized traders are now on board. No one wants to be long. Remember, let's go back one. No one wants to be long. Take a look at it. What's the market doing here? Anybody see this? There's a word for this. This one I'll watch the questions. Anybody know? Flush, okay, panic. Yeah, but there's a word for it. It's not a wash and rinse yet. What is it? What's the market doing? Describe this action. How about that? That's a better way. Climax, sell. Yeah, there's capitulate. But they all come to one thing: fear, dropping. Let me give you a better word. Ready? Selling off, sure. Pressing, selling to find buyers, exhaustion. I got a better one for you. Ready? It's vertical. Vertical. Straight up and down. Look at it. Straight up and down. There's no pullbacks. If you're short, that's the good news is it's vertical down. But the bad news is there's no stops. It's vertical. What tends to happen in a vertical market? Well, we know. We've done lots and lots and lots of studies. And when you see the market, and we'll do this a few times here in this section on the E-mini S&Ps. When the market goes vertical like this, it generally does one thing. It generally retraces the vertical movement. It doesn't mean it's going to head up here. That's not the conclusion I'm giving you. All I'm telling you is when the market goes vertical, if you're short, you might want to pay attention. You might want to put in a profit stop. You might even want to think about taking the money off the table. But as sure as the sun comes up, when markets go vertical, they tend to retrace like this, much more than 50% of the time. So price comes up, and you can see it tries to sell off, tries to make another high, can't. So it sells off, takes out this low, wide range bar. Look at the volatility picking up. And what do? We find buyers again. And down here, these are the big boys stepping in and saying, everybody is leaning short. I think I can pull the hair on their chinny chin chin. So they're stepping up. They sealed. In fact, they probably are sitting right here as well, because they're going to want to push it up here. Why? Because they can take some profits on their position. Sell half their position out. Now they're long all the way down here, if you think about it. They're just like everybody else. They're here to make money. Price retraces, and look at it go vertical again. Price zooms right through the top of the tight energy coil, and it becomes clear that the flow has turned higher. Everybody's buying. They got to buy. We've got stop loss buyers up here. It's the top of the coil. It can't possibly go through these highs. Well, it does. So they've got stops there, and they've also got the breakout buyers. And they push it higher. Whales don't chase price. They often wait for everyone else to lean in one direction and take advantage of the imbalances in the market. One easy way to read these signs, the signs of the imbalances, is a market that has gone vertical. When price breaks above the first major prior swing high, which in this case would be the coil, the retail and mid-sized buyers are forced to liquidate their short positions. They just can't take it anymore. We talk a lot about whales and whale tracks over market geometry. The reason why is that there are no other whales that are willing to talk. You can't even interview them. I am. I'm in my, Barbara gave me this nice compliment years ago when I first met Cynthia. I'm in my give back phase. You know, I have a nice life, a nice family. The CME has always been good to me, and I've made lots of money now. And at this point, and I manage lots of money. And my four clients, they don't even bother me. So what do I do now? I enjoy teaching other people what I know, because I don't want this information to be lost. So many of my people that helped me along the way never wrote anything. They did help people, but they didn't leave a legacy. You can't find Amos's work anywhere. Dr. Andrews' work is 61 pages. We give it away free on our website. There's a guy trying to sell it for a lot of money. You can get it free from us. I'm just trying to give back what was given to me. I'm trying to help you as people helped me. So we're up here. Now we've gone vertical again. Let's see what happens to price. I have to be honest with you, we're on slide 34, so I don't even remember at this point what it does. Okay, we're not going to go into it, but this is my partner Shane. This is one of his favorites. It's called flung. Price goes hard out of the hole, burns all of its energy, then it has to go gentle. It has to go into a more sustainable rally, a low volatility grind, or it'll fail. So if it doesn't transition into a low volatility grind, it'll then fail. It can't move like this forever. It just can't. So what does price do? I'll read this and then I'll add as I need to. After the initial stop loss buying, price begins a low volatility grind higher. We know that when price drops or rises vertically, the move is not sustainable. this slow grinding type of trend is very sustainable because most traders get bored out of their position. They were looking for high volatility and quick payoff moves. Instead, they get these, they're long, but they're getting this, and they're very bored. You'll get the market geometry address and all that stuff at the end, and as well it'll be on the slides, Lloyd. But I'm not here to get you to come or buy or do anything. I'm just trying to hear. Cynthia gives good information. I'm trying to help. This is part of the CME's Futures University, and that's all. That's all we're trying to do here. So slow, sustainable grind, extremely important. And you can see me mark out the push. The push is higher, but each push just comes right back down to the line of force. Not a good thing, not a bad thing. It's just an observation. When you see it move from a sustainable grind higher, low volatility grind higher, that's a marker for you. It'll cause you to sit up and pay attention, first of all. But second of all, you might be thinking, hey, I know how this one ended. Okay, you saw how this one ended with another grind. But it'll tell you that we're about to phase shift or change into a different, let me say it differently. We're about to change into a different phase of the market. We're going from a vertical, unsustainable to a nice low volatility grind higher. But this can go on and on and on and on and on. We see this, for example, in the Aussie. It'll grind for days and days and days and days. And sometimes it's hard to find, if you're in this section here, it's hard to find an entry. It's so boring, it's hard to find an entry. All right, so let's zoom in on this rascal. Price makes a series of higher highs, then makes 3 tight drives. See them right here. 1, 2, 3. So here we are, just grinding. This is, let me go back and I'll show you exactly where we are. Right here. Okay? And nice grind. We're making higher highs, higher lows. Then we form a mountain base. We come up and we make nice 3 drives to the top. Very old technical analysis technique from some farmers actually in Kansas. They used to sit around and drink coffee and mark up charts. And I've got a copy. Just some beautiful technical analysis. It leaves lower high for the first time in this push higher right here. You can see it take out these lows right here. See these clump lows? What do we have? Four lows, same size, same low. For the very first time, we take out a major low, and we leave as we take out this low right here. You can now mark this in. It's not only a series of flat tops, but it's now the first lower high in this entire move up. Significant lower high. So it makes you scratch your head. And what should you be thinking about? Well, what do we see in the bonds? We're going to be paying attention at the mountain base, at the baseline. We want to know, are the whales there? Now take a look at these bars. If you have to, literally, here, I'll tell you what I'm doing, and then you do it. I'm moving my head closer to the screen. Now, I've got 27-inch monitors. I'm moving closer to the monitors so I can see. But maybe it's just because I'm getting up there. I'm old, 54. So take a look. Look at the lows. New lows, new lows, new lows, new lows. Each bar is just, they're pushing it. Lower highs, lower highs, lower highs, lower highs. You can see these bars, there just are no buyers, period. Price is now right here. It's easy to see prices flowing. So what do we say? This market is in play. Instead of being stuck in a tight coil, why trade that? This market's in play. Now watch. This is all 7 minutes. Absolutely. All I did was zoom in. When? Well, let me read. I'll just read what I wrote. It's probably smarter. Price zooms lower through the mountain baseline right here. Price falling vertically again. There you go. No trader wants to be long. When price, let me go back. Does anybody want to be long here right now? Of course not. Who in their right mind would want to be long? Can anybody tell me who wants to be long? There is someone. Me. No, not me. Whales. And by me, somebody else said me meaning them. Whales, yeah, sure. They know everybody's leaning one way. They've got a reason to be long. They want to flush you out. Price forms a V bottom. How many times do you see this V bottom? You wonder, how the heck can I get in? This is price imbalance. When price comes all the way down here vertically, okay, it's price imbalance. There's nothing but sellers. But whales, for the most part, have almost relative to the rest of the market, have almost limitless ability to buy, especially if they form a pack, which happens. They see Jamie buying or they see me buying. Hey, let me get me some. Soon there's 3 or 4 of us. At that point, that's a lot of buying power. Can we change the trend? No. Can't. Can we wash you out of your position? Yes. So what happens? Price comes down here vertically. The whale stepped in and bought the market, catching all the traders that had chased the market to get short, leaning the wrong direction. Price came out of the hole as fast as it had entered it, quickly zooming back above the mountain baseline as those traders with short positions, right up in here now, with poor trade location, were forced to liquidate their short positions. Why don't we ever chase price? Because then you have poor trade location. And by poor trade location, if you're getting short on the breakout here, where's your stop? The real stop is actually all the way up here, because you always want it behind or above structure, above or below structure. And this is the next structure. So being short here, you're just chasing price. You can put a cash stop in, but you're guessing at that point. Now that there are 3 major swings, it's time to, and by that I mean this major low, this major high, when it starts to take out all these magnificent lower high and lower low bars, one after the other. When it starts to take these out and eat into them, and it's taking out the mountain baseline, it's pretty significant, and we can mark this as a V bottom and call this the probable C pivot. Okay. Now we can just draw it in: A, B, C. Traditional median line. Median lines have a probability built in. The probability says if you're at the median line and you turn lower, with 80% probability you're going to come to the lower parallel. If it's at the lower parallel and it turns higher, 80% probability you're going to the median line. If you break through the median line to the upside, 80% probability you're going to the upper parallel. And that's all it has to do, and the statistics are out there. They've been done over and over for doctoral dissertations, all kinds of things. And I've certainly done them. I run them all the time. The range is somewhere between 72% and 87%. The S&Ps are right at 80%. Here's our A, here's our B, here's our C. The relationship between the 3 actually generates statistics, and this is a true leading indicator, one of the few. Price comes to the median line, what's it do? It zooms it. That's an extremely powerful piece of information, that it had the power to zoom through the median line. Didn't even breathe, just kept right on running. And next bar, another runaway bar. Price takes out all these highs in one bar. The buyers are clearly in control of this market. But remember, where are we? We're vertical again. Look at it. What happens to vertical markets? Anybody? They tend to turn. Now, it's difficult to pick the top or the bottom, and that's not what I'm suggesting you do, but look for the signs that the turn is there, because as it starts to into this action, especially when it's just a couple bars and it's so vertical, you know that it's not going to go, you know, 500 handles higher without breathing. It's going to have to do something, whether it's consolidate or turn. It's going to have to do something. Vertical markets are not sustainable, period. Doesn't mean the uptrend's over. Doesn't mean a downtrend hasn't stopped when it turns, but they do have to retrace. No one wanted to be long, but the whales stepped in with solid buy orders and turned this market around to the upside. If I've repeated myself, let me just tell you, repetition is the best form of learning, so that's okay. As stop loss buy orders were triggered, price accelerated to the upside. You can see it right in here. First zooming the upsloping median line, which is here, and then making a new high for the move. And that's extremely important because that tells you they're fresh buyers. And it's not, I don't count 2 ticks higher a fresh high. It's got to blast through, and this one blasts through nicely. So you got clear signs of buying going on. Let's see what that leaves us. Okay, we consolidate. Here, now if you remember earlier, we turned from vertical into a grinding higher move. Here, what are we doing? Nothing. Nothing. After making new highs, price is stable for the moment. Is it time to be long, short, or flat? The water's fine, whispers the killer whales. Come on in. Come on in. The water's fine. Now, I have an 11-year-old daughter. I've got people saying long. I've got people saying short. There's a smart one. Doug says flat. Yeah, there's Paul says stay out. I have an 11-year-old daughter. She loves Microsoft presentations. She's a master at them, and she also draws very well. So let me just drive this home for you. The water's fine, whispers the killer whales. Uh-oh. Da-da. 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 The water's fine, whispers the whales. Let's go back and take a look. Ooh, look. The water's fine, whispers the killer whales. We break below the median line. We zoom it. Sure tastes good. The whales are eating the guppy food, aren't they? Pushed it over the cliff. Now, if you're a whale, what are you looking for? Think like a whale. What are you looking for? Not what do you do? What are you looking for? Think about it. I don't care if you type it in. Like I said, I can read your minds. Drama, something interesting. Sure, I like that. Let's see what we get. Again, the water's fine, says the killer whales, right in here. Everybody maybe steps in. We've got all this congestion. It's pulled back. I saw it, maybe I sat here and saw it trade all the way up here, didn't get any, had a chance to buy a pullback, didn't. Now it's breaking and making new highs. Okay, it's pulled back into congestion. Maybe just now it's the time. And of course, the water's fine. And now it's sure tastes good as they run your stop loss orders. Ah! Whales. Just when you think it's safe, the whales show up. Retail traders, mid-sized traders, whales, the guys that actually set the tone of the market. Let's take a look with a little bit of box work, as we did in the bonds. Try and see through the median line. I probably should have taken that off, but let's take a look. Take a look at this rascal. What do we have? We've got a tight coil. Let me read this first. There's nothing random about price action. There's nothing random about price action. When I went to school at the University of Chicago, and I have 3 doctorates from there. I used to laugh. My mentor in economics was actually Milton Friedman, and I used to laugh when they would teach it. They had to teach what the university tells them to teach, and I would bring in my statements. I paid for my university with my trading profits, and it was expensive back then too. By the way, it's real expensive now, but it was real expensive back then too. I said, how can you say it's random? I couldn't make this kind of money if it was random. Start with an empty chart and an empty head. Don't come to the chart and try and draw what you want, because you'll find an entry, you just won't like what you find. No opinions are ever allowed. Okay, go blank, start over again, both your chart and your head. Then begin observing until you clearly see repeatable patterns. So let's take a look. Take a look at this. We've got a nice tight coil, a scary drop, a sell-off, works its way higher, can't make it back to the lows, works its way higher, can't make it down to the prior low, then it finally breaks out of the box. Let's take the same box and just slide it over here. Tight coil, scary drop, works its way higher. Now we'll see whether or not it's going to work its way. At the moment, I'm calling this the C point. I could be wrong. Could be wrong. But I think I've got buyers here. Look at my multi-pivot line all the way across. I've got highs, lows, and lows. This is a great place. And what was this? This is the wash and rinse by the whales right here. So the last time we got down here, the whales were buying, and they pushed the market off a cliff, and they left a signature in the market for us, this wash and rinse. The question is, will they be there this time? Well, I've got something else going for me. This is the lower parallel, and according to Dr. Andrews, statistics show him to be true. Price should run out of energy. It should make it to the lower parallel, first of all, but it should also run out of energy here. Then it either will stop and reverse or accelerate. But I've got something else on my side, which is this multi-pivot line. So I've got the multi-pivot line going, and I've got the lower parallel. So I'm willing to enter a long position. I got one problem. Anybody know what it is? No. Well, I'm not wild about the stop, but we're going to deal with that. But I got, end of day. I'll get to the stop next, but end of day. And what happens at the end of the day in the E-minis in particular? 15 minutes off. What do they do in that 15 minutes? When you're not allowed to trade, they announce earnings. And this is one of those heavy earnings day. Not every day is created equal, so to speak. I can't remember. This was the week after Apple got the what kicked out of it until the end of the week. Actually, this might be the last day of Apple getting cord, so to speak. So during that 15 minutes, if you have a position, you can watch cash, but you can't do anything. If you have a future, you just have to sit there and watch and go, oh gosh. Now on this one, if I was trading futures, of course, where should my stop be? It should be underneath the C, right? And that's a fair amount of do-re-mi. But I really like this. I've got the lower parallel. I've got my multi-pivot line. I've got a nice line of force to the upside. I want to get long here, but I'm worried about the end of day and the 15 minutes when I might get absolutely hosed. This thing could gap 40 points lower, and I get filled. Where is 40 points? 60. Oh my God. 40 points. It's here. Happens all the time, and I sure don't want that. Do you want that? Nobody wants that. So let's take a look. Yeah, great. Steve's exactly right. Great setup for a simple call option. Why not? So what am I going to do? I'm literally going to just buy an at the market call. Nothing fancy. This is a for people like me, it's Dumbo options. Now, do I do it during the week on a regular basis? No. There's no need to. Okay? I can trade futures. I'm not going to do this in the middle of the day, but here I have a special need. The market's going to be closed. I want to limit my risk. If I had futures and this was the middle of the day, it's a 4-handle risk. I can afford that. I generally like 3, but I could afford that if I really wanted to. But because it's closed for 15 minutes, in my mind, I have no idea what the risk is, so I have to mark this down as unlimited risk on my trade sheet. That's what I've written right in front of me. Here we go again. You can hear my trade sheets. And I have every trade sheet for every trade I've made since 1982 and images. So here's what I wrote down. Unlimited risk. So I don't want a futures position here. Just don't. So I'm just going to do something simple. I'm going to buy it at the money call, period. 1364. Now, if we take out what I consider to be the C point, and it's not during the 15 minutes, if the 15 minutes are over and I'm here, I'll just get rid of whatever. I'll get rid of the options and take whatever premium's left. Okay? It won't all go away. If I watch a trade and it dribbles down and it breaks this, I'll take whatever premium's left and walk away. That's fine. Okay? But now I'm protected for end of day. I don't have to worry about it. And again, we still have a little bit of time, but that's fine. This is where I want to get long, right here, right on this lower parallel. Because I've got buyers that should be sitting right here. Now, I don't know if they will, but we'll see. And you can see I'm filled, and this bar, even though it closes nicely, this bar didn't open, I call it opening and closing the door. It hasn't opened the door. It didn't go down here and take a look and see if there were scary sharks in the water and then run up. It just kind of went to the door and knocked on it. Nobody answered. So we don't really know what's down here. But that's okay, because I know this is my risk. Next bar. Look where we are. This is the opening after the earnings. Oh, I'm sorry, I'm wrong. Let me read my own chart. I forget these are 7 minutes. So by the time we actually get to the end of the day, and I still like this, I'm well in the money. Okay, 64, we're up like 70, 71. And we're at the median line. It's a possibility this could be the end. We still haven't broken the prior highs. But I like this position. So we're at the median line. The question is going to be, now, for those of you who wonder, take a look at it. Andrews 101. If it breaks the median line, where's it gone? It's going right to the lower parallel. In fact, it overshot just about as much as it undershot above. Could I have been a little bit cheaper? Well, if I was trading futures, I might be. With options, I'm just using a pretty blunt blade because I just want to get in. End of day, where are we? We're right back at the median line. What does Andrew say? Down here, we turn higher, 80% probability, we're going to the median line. Sure enough, right to the median line. So now we're closed. Now I have to watch all the earnings come out. I actually don't watch. If you actually want the truth, I don't know and I don't care. When do I care? When they open the market again, I'll just look at price. Price tells me everything I need to know. Period. I don't read the newspapers. I don't watch the news. And God help you. I used to have a prop shop, and guys, I came in one day and the guys had put in this nice LCD monitor on the wall, this 42-inch monitor, and we're watching CNBC. I took it off the wall. I opened the window and threw it. We were on the 30th floor. Threw it down onto the street. I was so mad that they were that stupid. You don't watch that stuff. Just trade. Just watch price and trade. Yes, and we are kind of vertical, but we're closed. Nothing I can do. If I had futures, I might be thinking about that, but the most I can lose now is my premium. I'm going to let the market play out. Now, we call this going blue to blue. It's a saying from the very first private mentoring group that I did. I did 3,500 traders, 3,500 traders at the CME and CBOT when they were making the transition from off floor to being screen traders over a period of time. And Barbara and a couple other people there were nice enough to help me set up that program, and I call them the lab rats. It was wonderful watching all these people make the transition and seeing the mistakes they made. And these were all people that had, on average, 20 to 25 years experience trading, successful. First profit target, upper parallel. One of my buddies in the first session bought into my prop room. If I had 5 seats, $5 million to get in and get a chair. Andy, wonderful, one of the biggest S&P guys there was at the time. And Andy walked off the floor, got one of the seats, sat down. Andy and Drew together as a pair. Good buddies of mine, still are. They own Oprah's old studio, Harpo, and that's where their trading room is now. And I'm in Arizona instead. And so we call this blue to blue. If it goes from the lower parallel to the upper parallel, that's blue to blue. And that's the first profit target for me. So you could jump out here. The pattern of higher highs is still in play. It's a trend until it is not. Remember, we are Newtonian physicists trading the market. It's a trend until it's not. What's another Newton's law? A body in motion tends to stay in motion. A body in motion tends to stay in motion. How does that apply to trading? Trends are a trend until they're not. We don't want to get into forecasting. Yes, it's a vertical market, but we don't want to forecast that it's going to fall, okay? Because Keynes actually said that markets basically go further than you have the money to withstand. In other words, forecasting the market is a waste of time. Just let price tell you that it's turned. There are several ways to execute this position. You can take profits here at the upper parallel, which is perfectly logical. This is Andrews 101, which my statistics show is a high probability target. But since a trend is a trend until it's not, you could attempt to let the position run to the upside, moving your profit stops underneath market structure, which is how I chose to play it. And I've got calls. At this point, they're futures. They're acting just like futures, almost 1-to-1. And take a look. First target, what'd we do? We went vertical. Who said that? John Rich, yeah, sure, and Max. Went vertical, what happened? Had to restore energy. Went into a tight coil. We played around with the median line, couldn't break below it. Made another run up. Came back down, played with the median line, actually poked a bit through. I thought at that point this move might be over. I don't have it marked here, but before we took out this high, I had down here, if price breaks below 13, I think it was 1371, I'm just going to just take the profits and walk away. And now, when price breaks above this high at the upper parallel, because it was sloppy down here, I moved my stop here and said if price breaks 1376, I'll just close out my calls. So we take out this high, we overshoot. Take a look. We overshoot the upper parallel. Take a look at how far we overshot it. Take a look at how far we overshot it here. There's nothing random in price. You can draw these sliding parallels and measure them. Works pretty darn well. And you can see we're still just climbing higher. There are several ways to execute this position. I chose to attempt to let the position run, moving my profit stops higher underneath market structure until I exited the market. Let's see what we get here. Oh, what the heck. I guess we're missing a slide. I basically, right up in here, we had a climax vertical high, and I just exited the calls. When it went vertical again, I just exited the calls. You can pop it up yourself on your charts and take a look, and you'll see there's another vertical run, then it meanders a little bit, then it sells off some. But I mean, it's a beautiful run. Look at it. And there, if this had been your target, there's nothing wrong with that. That's a nice chunk of money as well. So these are short-dated, weak E-mini S&P options, and they trade a lot like futures. Are you going to get the same amount of cash as if you trade futures? No, but your risk is limited. So at the right time, this is a strategy you might want to consider. Are there other ways to use options? Absolutely. But here's just a simple, easy, I think it makes perfect sense to use this simple, easy strategy in these particular situations. And I'm a very, very active trader. I don't use options that often, but when I find myself at a point where I write down unlimited risk, the first thought I have is flat. Never mind. The second thought I have is, wait a second, I wonder if an option strategy would work here. And I tend to go very simple. Somebody asked, so we're in the, all right, so first of all, thank you for taking the time to attend this session. I know you guys are all busy. You've given me already almost 2 hours, but we're going to answer all the questions that you got. Cynthia, you want to jump in now?
Yes, I would, Tim. Thank you. And I'm going to give Tim a moment to take another sip of tea, and he'll be back with us to answer some questions. Now, while Tim is taking a breather, I do have a request for everyone here, and that's to answer a poll. IB's management does require this in each of the sessions to make sure that you are getting information that's relevant to your trading needs. So notice that polling panel has opened up. It'll only be up a few moments here. So I do ask that you make your selections and then click the submit button. Do appreciate the feedback. Now also notice question number 2 is an input field. Don't put your questions there, but if you've got comments or suggestions on other topics for webinars, that's a great place to put it because I do review this with management weekly. So now, want to let you know, poll will end in about 5 seconds, so please finish up and click that submit button. By the way, if it does end too quickly, and it just did, you can always send those comments or suggestions to me at webinars@interactivebrokers.com. So thanks, everyone. I do appreciate that feedback. Really does help. Now, also want to let you know that you can close that polling panel by simply using the X in the title bar. Also, that chat panel has probably collapsed down at the bottom of the screen, but simply double-click that title bar and you can reopen up that chat panel and send any questions that you may have for Tim at this point. So, Tim, back to you.
All righty. And again, I appreciate all the time you guys spent. I know, again, two hours on anybody's day is a lot. Believe me, we spend a lot of time putting these together. And let me give my props to my partner, Shane Blankenship. Without him, I would be lost in the water. He's, a tremendous part of this. Shane, buddy, I couldn't do it without. Also, his wife, Wendy, manages both of our lives. So without her, we'd be walking into the wall. Let's see if we can answer some questions. A simple drawing one where we're going to ask a question about why didn't I draw at 4 o'clock instead of 6 o'clock. I'm going to just hit pass on that. You can email me a chart if you want, and I'll be glad to answer. And look, if you go to marketgeometry.com, there's a space that says contact us, or you can just, I'm timothymorge@gmail.com or timothymorge@marketgeometry.com without a space. Either one will get to me, not a problem. So let's see what we got. I'm going to skip some of these. Just be patient for me. I'm trying to switch gears. All right. AR says, considering the price did not touch the upper parallel, should we expect an undershoot? And in fact, we showed the undershoot did exactly happen. And not only did we get the undershoot, which again, if I traded futures, I could have been a little cheaper and maybe put them on at 1363. But then when it went to the top, it overshot the exact same amount. So as I said, there's nothing random in the market. And you can use that that slop, if you will, undershoot and overshoot, to really hone in on the market. So that's a very good observation. Wendy says to me, yes, that was Apple's earnings after the bell, and everything turned around. Yep, because Apple was being turned into applesauce at that point, but not after their earnings. Won't you have to hold the calls overnight? Yes, absolutely. Daniel, that was the whole reason I was willing to do calls, not futures. Is I wanted to hold them during the 15-minute period, and if it unfolded nicely and I had money in the calls, if I wasn't washed out, I could let it run till I decided that I wanted to get out. With options, I have right in front of me, I know exactly how much I'm risking, period. No, I mean, that's all. The price of the call, that's all they can get. Hey, Christine, nice to see you. If the strike isn't offered at the money, would you go above or below? I think it's meaningless. I probably would pick above because I think it's in an uptrend, so you'd be slightly in the money. But you know, it's not going to make much difference, especially the E-minis. They're pretty liquid in terms of strikes. This kind of looks like the YM 5-minute. Yeah, you know, at times when you're looking at the 7-minute E-mini S&P, it does look like the YM, absolutely. Everybody caught the vertical move. That's good. I wanted to drive that point home because so many times, you know, traders at the top of moves when things go vertical and they're long, instead of worrying about paying attention to price action and whether or not they should be taking profits, they're doing the happy dance. So we don't happy dance. We pay attention to price action. When we see verticality like that, you know, if you practice it, we call it myelination. It's changing the neural pathways in your mind, literally. If you practice that and think about it on a regular basis, when you see things go vertical, you'll immediately start to ask yourself, how's my risk? Do I have a good stop, a profit stop? And if not, maybe I want to exit or exit some or something. So unlimited risk, Steve says, equals good time for insurance. And in quotes, he says options. You are exactly right, Steve. Well, thank you. Mike has some, I have some, I'm blushing. Some of the things you guys are saying are just wonderful. I appreciate it. How do you recognize which point is A, B, and C? Well, Max, you know, on these, let me just go back one. I'm not proud. There we go. Look, it was the major low. Now, how do I choose B and C? At this point, if you take a look, this is very simple. First, I had a marker here, which was the wash and rinse. And that means they knew everybody was short, so they pushed it. They get everybody that isn't short. Now they've got the breakout buyers getting short. As soon as everybody's short, they pull the string on them. And when price is up here, they have to start covering. That's called a wash and a rinse. All right, so I've got that as a marker. But more important, if I just look at the width of this swing from B to what ends up being C, it's the widest width up until this point. So I'm going to pick A and then the widest BC for my median line. You can see did a pretty good job giving me all the way up the probable path of price, which is what median lines do. All right. Why would the profit from trading options be less than if trading futures? That's a good question, Georgie. Well, there's two things. First of all, the spreads on options are wider than the futures. Futures, there's no spread. It's just the bid and offer are one tick. Options can run from half a point to a whole point. So that's part of it. So figure a half to 1 point in, half to 1 point out. That's the first part. The second part is, especially down in this area, you're getting in, and you're getting in at a point where everything is discounted. So you're paying, I'm going to say, 120% of what the stop would have been in the futures in general, 125%, something like that. But that's okay because I've gone from unlimited risk, because I don't know where it's going to open. I'll pay that extra 25%. Now, eventually, it's going to catch up to the futures. But in the meantime, this part is lost to me. So on a good futures trade like this, I'll tend to pick up about 80% of what I would have, if I'd taken the options position. I'll catch about 80% of the profit that I would have under the futures. And that's more than acceptable because I went from unlimited risk to limiting the risk. That's why I'm willing to do it. Somebody says, I want to join. Well, you just go to marketgeometry.com and there's a beautiful trial thing. Come and see us. But I'm not here to sell anything. So quite honestly, I'm here every month, the second Thursday. And I'm here because, first of all, I'm a CME guy since 1980. I love the CME. The CME has done wonders for me as a trader. They've supported me my entire career. So I'm giving back. And second of all, I can't tell you how wonderful it is to work with Cynthia. And Cynthia, although she works for IB, she's like me. She's not trying. She's tried to sell you anything today. She's not talking. She's not. Oh, here, open an account here. You must do this. This is very, very unusual. This is why I like to work with IB. They want quality education. That's all this is about. And so think about it that way. And that's my hats off to them. That's why I love to do things with them. If you're using futures contracts to hedge your well, see, now you're in trouble. When you start to talk about hedges, I don't do that, Lloyd, but I'll read your question anyway. Me, I'm in or out. I don't hedge anything. But if you're using futures contracts to hedge your options position, how many futures contracts do you need for each 10 option contracts? I'm not sure how that works. Well, good luck with that. Lloyd, you're going to have to go back 2 weeks ago. Futures University, sponsored by the CME. They went through all that stuff. I don't trade that way. I don't hedge my positions. If I don't like my position, I walk away. Period. Same thing with my options position. You didn't see me try and hedge it. I said, thank you, I'm out. Bye. Done. If I have a futures position on, the worst, in my opinion, it's just my opinion, the worst thing you could do is then take an options position against it. If you don't like the position or you're not sure about the position, close the position. You can always find the position again. But if you're thinking about hedging, move on. Max says he's new to trading. Well, you know what? There is a ton of free stuff at marketgeometry.com. And you think I'm here to sell something? Let me just tell you, Max, before you spend a dime, go through all the free stuff. And there's over 100 articles. There's all kinds of video clips. There's at least 10 IB webcast links there. Go through all that stuff free, way before you even think about spending a nickel. Don't spend a nickel. Go through the free stuff and make sure it makes sense. Sharon answered Lloyd's. Thank you, Sharon. Sharon answered Lloyd's question for me, so I guess I should have just read lower. But, take advantage. MarketGeometry.com and MedianLine.com. There's all kinds of free stuff. Before you go spending money, read this stuff because it'll take you months to read all that stuff. Trust me. What I find hard to gauge is which pivot in the market structure is important. Oh, I can understand that. For example, I don't know, the important pivot from wave within a wave. Can you recommend any tips? Here's my best tip for you. I always start with the lowest low. Then I go to the widest BC. I can always switch up. Here's an example. I might move this A up here to the bottom of this multi-pivot line and see how that looks. If this doesn't work, or I might take this specific median line, and although we have median lines in this presentation, if you go back at prior sessions, they're much more median line intensive. There's something called a modified shift, which would be up 50%, over 50%. So my A would be right here. Doesn't look so bad now, and that would gentle the slope of this. But in this case, you can see this traditional, the normal median line, did an awful good job of capturing action. But there's another way. We call it a width median line. You could say that we didn't get an ignition until this point, where we took out this high. So maybe you choose this as the B, and this is the C. Of course, it doesn't use the lowest low. Those are different, but I would start out with this one right off the bat. Major low, widest BC. Generally, that captures a whole lot of the probable price. And don't try and be too esoteric. Let's see. Arturo, hey, I got your emails. Hopefully you got them back for you. I know you were at the last one. You sent me some emails, and we answered some questions. And he's got a thank you, Cynthia. We got another thank you there, Cynthia. Let's see. Oh boy, you were showing how price broke through the median line. Prior to the breakdown, it seemed the price was respecting the median line. Would you have taken that long on the median line retest the second touch of it? Slide 43. Are you in a hurry, Cynthia, or can I go back and look?
Go right ahead, Tim.
All right, Don.
The drop-down arrow will let you go direct to the slide. Oh, you're there.
I'm not that smart. I know it does. You know, I know it does, but when I actually try and do it, I don't. So you're asking right here. There'd be nothing wrong with it. If, I can actually draw, can't I? I'm just not that smart. Let's see if I can draw straight. Little fatter than I wanted, but you get the idea. Here's a multi-pivot line, and it's coming right in at the median line. So if you'd taken this trade, there's one reason I might not have, is that it didn't make it to the upper parallel. And there's a rule called the Hagopian rule. We won't go into it too much, but if you come to market geometry, there's lots of free articles that'll explain it to you. But if it doesn't make it to the line that it's supposed to, that signals that it should make it at least to the lower parallel, if not further, okay? So that might have scared me off, first of all. Also, I'm watching this action. If you took it, look at it this way, Arturo. Or, that's the question. Brian, sorry. If you took it, look at it this way. You just get stopped out. You always have stops, right? Now, at this point, we're not trading. But if you're trading futures, I've got my 3-handle stop if I take this trade, and I'd be underneath this structure. I'm not wild about this structure. That's another reason why I wouldn't take it. Where's the real stop on here? The real stop is actually right there. Because look at the vertical move. There's no swing lows until you get down to here. Now, no buyers stepped up. They've got nothing to lean against. So here, I want to see. It's calling buying a bar. I want to see what they do here. And as I watch, it gets there, it tests it once. It can't take out these highs right here, and then it blasts through. So, might I have taken it? Sure. But if I did, the most it would do is cost me $150 per contract, nothing. That's why I limit my risk. Okay, I always have the same size stops maximum in each market, and they're all equivalent. If you take it, it's okay. It's not the worst setup I've ever taken. If I would have taken this one, but I also know they're likely to push it off this cliff. Didn't make where the line it should have made. Everybody's long. It's scuffling. They pushed it off the cliff, as Lucy said and Shane said. Sure tastes good as the whales eat the guppies up. So let me leave it there. All right, let's see. Tundi says, I'm going to read this anyway. I know you sent it to me privately. That's okay. I won't tell. Your last webinar helped me be profitable over the last 2 months. Congratulations. I'm sure it was 90% you and only 10% me, but congratulations, and I hope this helps you long term. I noticed that some pitchforks in opposite direction of the trend would have worked. Is it advisable on long-time charts? On longer-term charts, portfolio trading I call it, I generally tend to have an upsloping and downsloping chart, opposing lines always. In other words, so I'll have a upsloping and maybe I'll have drawn this median line using this, and this, and it would have given me something like a median line that goes like this. And then see how they interact. And you can see, just drawing this, where would I be looking to get long? Right there. Which happens to be at the multi-pivot line. So knowing those two lines of opposing force, I don't think I drew them in. There's Lucy's work again. So if I drawn in the down-sloping median line, it would have given me, again, the same basic area. So that's the beauty of using lines of opposing force. Absolutely. And congratulations on your 2 months. Let's make it 3, buddy. Ouija. First chart was gorgeous. Absolutely. And Ouija picked me up here. Has been here through 3 or 4 seminars. I've been sending emails back and forth. Could I ask, how do you account for the time factor when you project the target profit on a sloping median line when you're trying to enter a trade? I eyeball it. I literally take an average size. Let me see if I can. I'm not going to try and go back and find one, but let's just look at an average bar, and I'll mark. This is about an average size bar underneath here. It poked up above, but these are too small. These are too wide. This is just about right. I'll take an average size bar, and then I'll literally just mark it in. I'll go bar, 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 and I'll overlap them by 1/3. So I think it's going down. I'll make lower highs overlapping by 1/3 the average size bar. You can run an Excel spreadsheet if you want. You can also run the average true range in a lot of charting programs. Just take the average true range and take bars that long and just plop them down, run one next to each other, and it'll actually give you a better feel for where it's likely to run. But a lot of times there's lines that you can draw in. For example, this multi-pivot line helped us. If I draw in the downsloping median line, it would have helped us. That'll nail time for you as well. But one way is to just draw in actually the bars overlapping by 1/3. Good question. Here's another good question from Brian. In previous sessions, I've heard that you mentioned using 13-minute bars. When I use 13-minute bars, I'm using day only, and it starts at 8:30, which is when the cash opens, and my chart closes at 3 o'clock Chicago time, which is when the cash market closes. So that's 390 minutes. If you divide it equally, you can use 39, you can use 13. I like 13. Today I'm using 7 minutes. Yep, that's right. And if you asked, is that due to looking at a 24-hour chart versus a day only? That's exactly right. And 7 works very nicely. Whatever paints a pretty picture, and lately 7 has been painting very pretty pictures. I could be at a 15, it would work just as well. And 15 divides equally, by the way, in a day only, if you go all the way to 315. Is the next session on June 14th? Cynthia will tell you it's the second Thursday of every month.
And that happens to be June 14th, so Mary's right on top of it.
Yep, and not only that, we can even tell you what it's about. Ready? Bonds. Am I correct?
Actually, I think we just switched out, I just switched some items with the School of Futures out, so I'll have to let you know too. Barbara just sent me a letter earlier this week. So, so that everyone knows, what we are doing is a School of Futures is actually CME talking about the different product complexes that are available. And Tim will follow that School of Futures presentation, which is an introductory presentation, and Tim will follow it with more information and go deeper into those product complexes. So Tim is going to be with us the second Thursday of every month. So Mary actually had it figured out. In June, it does fall on the 14th, but we did want to leave you with a recognizable date, so simply mark your calendars. As soon as we get our topic description out, we post the webinar on our website. So please do check the website. Now, if I can, while I've got their attention for just a minute, Tim, because we've got a wealth of information. If this happens to be your first or second webinar, we do archive and store all of Tim's presentations on our website. Simply go to the Interactive Brokers website. Underneath our education menu, you'll find a link to webinars, and all of Tim's are included on the industry-sponsored webinars. So if there is a filtering box up on top where you can filter by speaker and view all of Tim's previous presentations. Now also, don't forget to look for the webinar notes, because as Tim mentioned, he's including all of his notes directly on the slides. So you can either listen to the playback or just download the slides and follow through on each of those presentations. So definitely do check that information out.
Yeah, and the nice thing about the way Cynthia set this up is when the download comes, as you leave, it'll say, do you want the PDF? And by the way, if you forget to get it, all you have to do is go back to the link and click it again, and and just end the video, and it'll say, do you want the PDFs? Just say yes. It allows you to download it. It comes in PDF form. It prints out beautifully. So let's say you want to just print out the stack. This is 51. I've got them in front of me. This is 51 pages. You just print it out, and then you can mark it up yourself. You can take notes on it. You can see exactly what I was thinking. It's a very nice way to do it. I actually give these to my buddy, Dr. Gary Fujinami, who's my acupuncturist and also one of my trading buddies. And after the IB thing, because he's practicing right now, so I give him my charts afterwards when I see him later in the day. So that's where mine go. So anyway, can I see a way to fit trading deep out of the money options? That is, and I'm not even going to mention the name, with median line analysis. Sure. Here's the thing: median line analysis will give you the direction. Then you can fit whatever style of trading you want around it. And that's as deep as I'm going to go today. I've checked. The median line shift works nicely here too, says Peter. Hey, Peter, how you doing? Brian says, okay, it makes great sense. Okay. How do you get the slides in PDF? As you leave, Val, they're there. You can't leave without them. Well, you could say no. It'll ask you, do you want them? And then it automatically just downloads them to your computer. Cynthia's done a great job setting this up.
And if you happen to miss that as you leave, check our website tomorrow. You'll find that on the education menu I just described. Those notes will be posted as well. So we try and leave them out there so that you do have access, whether you listen to the webinar or simply want to come back and view those notes, Val. But thanks for asking.
Max says, Mr. Tim, by the way, no one has to call me Mr. That's my dad. Can you please tell me if someone says to draw forks from the outside in and not inside out? Well, there are inside median lines and outside median lines. The problem with drawing them the other way that you're talking about is they're curve fit. In other words, you're using points up here and then pushing them backwards. And you have to be very careful because at that point, they no longer are predictive until they've proven themselves. So I'm pretty slow. I do use them, and I have a book where I show how to do them, but they're not my favorite. And the reason why is because they're curve fit, and a lot of people get lost. They forget that they're actually trading until you don't want to trade it until it gets tested. Let's leave it at that. So you can use them, but use them with caution. And if you go to, again, you don't have to go buy a book. If you go to marketgeometry.com or medianline.com, there's articles that will talk about inside median lines. Excuse me, how to draw them, how to use them, when they make sense, when they don't. You'll get it. So let's see. Tony says he's going to make it for you. All right, buddy. Oh, send me a chart. Okay, I'll look at it. No problem. He says he's surprised that the blogs are free. You know what? That's fine. We're here to help. Honest, I know it sounds funny in this world, but we're trying to help people. I'm here today because so many people helped me. I can't tell you what it meant for me as a teenager. Imagine this. Amos Hofstadter was a centimillionaire at the time, and he could have just brushed me off. But I was spending the summers at Princeton, and you could literally walk from Princeton down to Commodities Corporation, and he was nice enough to just, whenever I walked in, to just sit down with me and go over my charts and talk to me. And I spent literally years doing it. It was just magical. So I think.
Well, from my end, it looks like we're about to wrap this up. And yeah. Tim, thank you so much for all the time that you've spent with us here today. We all certainly appreciate it. And I also want to thank CME Group for making today's and this continued series available to everyone. Thanks to the CME as well.
Cynthia, is it okay if I give Barbara Schmidt-Bailey a big hug and a kiss? Because, as you know, she got one to you as well. She got you and I together. I mean, I can't even remember how many years ago, but I mean, she does such a great job finding new ways for us to do things integrated like this. And I've already told Cynthia, lock up next year and let's just keep right on going. So if you already have your 2013 calendars, just keep marking them, because we're just going to keep doing this and doing this. It's so much fun. It's great to be able to work with Cynthia and Barbara, and now we have Mark involved, and we'll just keep bringing more and more people.
And if everyone would just remember the second Thursday of every month, we're going to be here doing the very same thing. So looks like, again, Tim, thank you so much. We are so fortunate to have you. But we are going to conclude today's event. So everyone, watch for those slides as you leave today, and be watching your email later on if you do want to come back and review any of the concepts that Tim discussed today. So Tim Morge, wonderful being with you. I can't wait until next month's presentation. Thank you so much.
Thank you so much, Cynthia. Thank you to CME Group, Barbara and Mark. I appreciate it. And Cynthia, I'm going to see you in a month.
All right. Save time. It's a Thank you so much, Tim. By the way, everyone, you can exit today's presentation by simply using the X in the upper right-hand corner of the screen. Thanks, everyone. Appreciate the time that you've spent with us this afternoon. Have a great day, and do trade smart. Thanks, all.
Take care, everybody. See you later.